All right. Well, here we go. Why not just start like that? So welcome to those listening, which is literally zero at this point right now because we're in pilot season, baby. We are episode 1 of the Pickers Market. I am Jeremy Bryan. I'm the senior portfolio manager here at Gradient. Who I got with me today?
Tyler Ellegard, just a normal.
Yeah. I didn't do any hazing. You didn't have to go to a trash can or anything like that. What are we doing here, Tyler?
Yeah, I mean, I think part of it was we've always done videos for as long as I've been here and even longer. And I think this is a fun way for us to kind of transition to more informal-ish way to talk about what's kind of going on in the markets and get some information out to our clients.
Yeah. We do a lot of button-up stuff, right? We do a lot of stuff that just kind of, here's the subject we're going to talk about, and we try to make it as relevant and relatable as possible, but it's very structured. Yeah. This is going to be much more freeform, as you can already tell, right? Is it? We're trying not going to work. We're not going to get crazy, but we're going to talk about some things that are finance oriented. Hopefully, you learn some stuff, but we're also just going to have some conversations that we're having in the office, right? This is what we want it to feel like. In this is what are the stuff that we're talking about in the office where we're all sitting right next to each other and we just throw things at each other and we say, hey, what do you think about such?
Yeah.
Right?
What are we seeing? What are we doing?
Yeah.
Just keep it informal, have some fun.
Cool. So why do we call it the Pickers Market?
Well, I think we came up with the title partly because everybody seems to do bull and bear something or other. And all we hear on CNBC all day long is it's a stock pickers market. Yeah. And so a little play on words there and kind of make fun of that because everybody every year says it's a stock pickers market. So when is it not?
Yeah.
So I think it was just a fun name to get away from the classic bull and bear type stuff and have some fun with the people on CNBC.
Exactly right. Exactly. I mean, the Pickers Market. I mean, I said it's funny because when it comes out of the state, I'll literally yell at it. And, I guess it's the stock Pickers Market, everybody. Yeah. I'm glad we still got a job. We can know what we can do. Yeah, our thought is it's always a stock Pickers Market. It's just different. Stock picking.
How
right?
are you investing?
Yeah, exactly. Because that's what we do. We pick stocks here, and we pick stocks. We pick ETFs. We do those kinds of things. But we're active managers, right? And so that's what we're going to talk about in a lot of the stuff here. Is what are we paying attention to? Why are we picking certain things? What is interesting to us? If we can kind of relay that to you all, that's even better, right? So, we're going to talk about, obviously we're going to do this in a longer form, if you will, but we're also going to try to segment them. So if you're not interested in one particular thing, maybe we'll have a clip on something that actually makes some sense to you. So can you walk us through just maybe some of the things that we're talking about from the subject matter and the things we'd be looking at?
For sure. Yeah. So I think the main point that we'll talk about is we'll call it the hot button, right? So what's going on for the last week? What is that hot topic? We'll kind of walk through why it's important and our thoughts on it. Mm-hmm. And then we'll have other ones like nerding out because, both of us like to nerd out on different things.
Yeah, our complete dorks. Yeah, that's
so we'll have a segment on that, maybe throw up a few charts here and there along the way. But I think that'll be a fun segment for us. And then we'll have one where it's like, wait, what? What happened? Why is that happening? And then I think another fun one is, the older versus younger. I think that'll be an interesting one on the subjects that we'll get to for that. And then we'll do just a spaghetti wall, throw something at the wall and see if it sticks. And we'll talk about some fun subjects.
Yeah.
And it won't always be finance oriented. It could be sports. It could be economics. It could be, who knows, books.
You see how Tyler's avoiding movies is because, so I'm a movie person and I people of my generation, this might be an older, younger segment down the road, but people of my generation, we live through quoting movies, right? And Tyler just looks at me half the time like I have no idea what you're talking about.
I am not a movie guy. I have like my 5 or 6 shows that I'll kind of go back to and rewatch.
What's number one on that list? What is the I've watched this the most?
Oh, I think, well, Friends will always be
Okay.
a classic. My wife is a Friends junkie.
Got it.
And then I think I'd have to go with like NCIS.
Interesting.
Just like the original NCIS, not like NCIS.
Do we have to flip older versus younger? Because you're like the only one under 35 that I'm guessing has ever watched NCIS.
And it's still going too, which is crazy. So I think those are probably my two go-to shows if I have nothing else to watch. I won't turn on a movie because I just can't sit there for 2 hours.
Got it. Yeah, I'd have to say Breaking Bad and The Wire. They're probably the things I've seen the most.
I started Breaking Bad, but I just never couldn't get through it.
Sacrilege. Sacrilege. Man, you really got it.
Yeah.
So this will be my disappointed face, as you can see on video, and expect that constantly when we talk about pop culture stuff.
Ongoing.
Cool. Well, now you got a little sense. Oh, and just, from our perspective here, Tyler and I will be kind of the main staples of this, but we're going to bring some other people on. For those of you who work with us at Gradient Investments, you probably all know Keith Gangle. He'll be a regular part of this too, just not today. And then also Lisa Schreiber, one of our analysts, will be on there, and we'll even bring David Ammett every now and then to come on as well, and just kind of, hear voices that are outside of us, right? Yeah, exactly. You don't want to hear me drone. There's a running joke at the office that's pretty much all that happens anyway. So you don't need to hear me. They hear me enough. You'll hear me a little bit more, but we'll bring some other people on for some entertainment once in a while too.
Which will be fun. and maybe even some guests, outside guests as well. I think that might be further down the line, but I think we'll try to bring on some outside guests.
Yeah, for sure.
Outside of our team, I think will be a good addition to the podcast.
Yeah, totally agree, because we do see, and we, obviously what we do at a living, we interact with a lot of other people, and if they're so inclined, we'd love to have them on and kind of pick their brains as well. Right. So yeah, for sure down the road, I think that's a thing we'll do. Good. Well, I think are you ready to start?
I'm ready.
All right,
I do think we need one of the clips.
Oh, yeah. The little movie. Well, I thought you didn't watch movies, I don't know. Well, I guess they do it on TV shows too. So yeah, with that said, karate chop, let's get started here. So let's start with the hot button. And I think, the hot button here is interest rates right now, right? That's what everyone's talking about. And especially kind of the shift in expectations of what's happened with interest rates, the thought process of last summer versus then the fall and into winter and then now. Can you kind of walk us through just kind of the elevation or the evolution of that, I should say?
Yeah, well, as we entered, maybe it was around October, November, where interest rate cuts from the Federal Reserve started to get priced in. And it was pretty significant, the amount of cuts, like 6 to 7 total cuts for 2023 alone, which you normally don't see. Right? No. I mean, and granted, we've been at zero interest rates for however long, and now we've had this fastest increase to 5.5% or 5.25%, whatever rate you want to go with. But 6 to 7 priced in, and I think that was a good portion of why the market rallied into the end of the year. Mm-hmm. Now there was some additional optimism around consumers and the health of the consumer, but I think generally speaking, 6 to 7 rate cuts priced in for this year was a bit dramatic.
Yeah.
And our opinion was coming into the year was 2 to 3. And so the market was over exuberant on 6 to 7.
To say the least, yeah.
Because that means more money can start flowing again. Cheaper interest rates, more money, more loans, that type of thing. Yeah. So it seemed aggressive, to say the least. And now some things have shifted, right? We've continued to have strong economic growth. GDP, I think, coming into this year, I think was expected to be below 1. And now we're sitting at, for the full year economic growth, we're sitting at like 1.6%, which is still not the average.
Right.
But I think it's better than expected.
Sure.
So we have that. We have inflation that's staying pretty sticky. We actually saw a pretty significant increase from last month. And so all of these things are now coming to the forefront, and the market is now only pricing in 1 to 2.
Yep. Because
the Federal Reserve, with strong economic growth and high inflation, there's not a lot they can do besides keep the rate where it's at, or, if you want to go the other direction, if you want to start considering any more rate hikes.
Ooh. That'd be real fun.
I think that would shock the market.
I think that would absolutely shock.
I don't think the Fed's going to do that because I think they know it will shock the market. But it's just interesting that all of a sudden we go from 6 to 7, in a matter of months, and now we're sitting at 1 to 2.
Yeah.
If that.
Yeah, I mean, that's, the prognostications, if you will, the consensus got really they got out of whack, right? I mean, I never understood give me the thesis for 6 to 7 outside of a recession, right? I mean, sure, recession where we're losing a bunch of jobs and all that stuff. Yeah, you're probably going to want to cut to support the economy so that it doesn't fall deeper into recession, right? Well, outside of people predicting a recession, there was never any real signal. There was the inverted yield curve, all that fun stuff that has precluded recessions in the past. But if you looked at jobs, if you looked at airports, you looked at restaurants, I didn't see any, recessionary conditions out there, and we still don't, right? I mean, for the most part. So the 6 to 7 was always, in our opinion, I think, kind of crazy to expect that much. And I think part of that comes from, and you correct me if I'm wrong, part of that I think comes from just we're used to cheap rates, right? We got so used to it. The Fed, at any signal of problem, they're going to cut rates, right? We're still at, or maybe even slightly below long-term averages, right? I mean, we're not at, we rose really fast, but this level isn't abnormal in history.
Well, and that's what shocked me was we weren't even expecting negative GDP growth.
Right.
We were still expecting to grow. Yeah. So why have that significant cut? I could get behind 1 or 2 or 3 this year to say, for the Fed to say, hey, we're a little bit too restrictive, so let's pull it back a little bit. But to cut by 1.5%, I think was way out of whack with what I think our expectation was, at least.
Yeah. And I think now we're probably closer to what the general population thinks, right? 1 to 2, certainly possible, probably more late summer, fall type of thing at this point now. But really, again, it's not like, I'm saying 1 to 2. Do I know? No, absolutely. What the Fed is saying and what we're saying is pretty consistent. Is it depends on what's going on, right? If we do start to see those airports start to get empty, and we start to see those restaurants get empty because people are worried that they're not going to have a job in 6 months, sure, we're probably going to see more aggressive rate cuts in the future. If we stay kind of where we are right now, 1 to 2 is probably right, because they don't need to be as restrictive. But they're not going to do that until they see the writing on the wall.
Right. And I think the other thing that was interesting was the Fed was still hawkish last year coming into the end of the year, right? All the Fed presidents were still saying, we're data dependent, we're not cutting.
Right.
And all of a sudden the market is expecting 6%.
Yeah, you are.
Right. Well, and I think we got into that cycle where the market priced in a hike and then the Fed hiked.
Yeah.
Right. Because, they were a little bit uncertain on where the data was going.
Sure.
And so all of a sudden, market prognosticators were saying we need a hike to restrict this inflation rate. And so the Fed would all of a sudden start changing their tone, and then you started to expect them to hike after the market had already priced it in.
Yeah.
So now I think they were going in reverse, and the Fed's saying, no, we're not.
Yeah.
We can't, because the data that we're watching isn't showing the slowing that we need to bring down that rate.
Yeah. I think, to put a bow on it a little bit is just to say, calm down, right? I mean, we'll see. We don't know for any certainty, but right now, the market has gotten so used to using the Fed as kind of the lever of where we are and what we're doing. We're also going through earnings right now. That for me, that's a lot more important, right? Is that the Fed's going to do what the Fed's going to do, but from our side, what are the businesses talking about? I mean, that's what we need to get back to, in my opinion. Here, I wish we were talking more about earnings and less about the Fed. I mean, that's really kind of the thought. But right now, we're obviously going to communicate it because, again, the hot button, this is what everyone's talking about. So we want to at least address it, but understanding that this is only one element. And historically, this is probably the less important element than what our businesses are doing rather than what's happening in monetary policy.
This could be a good nerding out section for me because I love economics. And this is probably a discussion for, another day. But I think the other thing to really consider is the Federal Reserve, I don't think has as much impact on the inflation rate anymore.
No.
Because our economy used to be solely driven on goods.
Mm-hmm.
And that's where they could have a significant impact on the cyclicality of the economy. But now we're much more service oriented. And so I don't think that translate as well from goods to services and hiking rates, because you're going to continue to use services. And a lot of the services are things that you have to have.
Yep.
Right. So I think it's just
or at least things we've gotten used to having.
Yeah.
Right.
True.
To where it's painful to get rid of.
Yeah. So I think it's a different setup than what they've had to deal with in the past. So I don't know if there's as big of an impact, but we could actually go down that.
That's definitely it. That's a good nerding out segment. Let's save that one for future. But let's transition here a little bit in just talking about one of the asset classes that we use here and that are interesting. So let's do what you might not know about. Let's do money market mutual funds. I know that's probably somewhat boring, but from our side, because people are just like, I know what a CD is. I got a pretty decent sense of that. What's a money market mutual fund?
Well, I think it's a combination of a lot of things.
Yeah.
Right. And we hear a lot on financial networks that there's so much money in money market mutual funds at this stage, and there's trillions of dollars at this point. And they're quite simple. And I think it ties in with the Fed, right? The interest rate that you earn on your money market follows closely with what the Federal Reserve is doing. So if the Federal Reserve hikes, you'll earn more interest. If they decrease rates,
you're probably going to get less.
You're going to get less. Same thing with CDs, right?
Yep.
But a money market mutual fund is just investing in ultra short-term debt securities. Mm-hmm. Now, depending on the type, I think I looked the other day, one of the ones that we hold in one of our portfolios is stable value. They hold 80% of the fund in 1 to 7 days of maturity securities.
Gotcha.
So they mature within 1 week.
Yeah.
Basically.
So very, very, very
short. And then 8% was greater than 180 days. And then they kind of filtered out in between.
Sure.
But there's a whole host of different securities that they'll hold in there. They'll hold treasuries that are
maturing very soon.
To maturing. They'll hold repurchase agreements, which is a big one. I think that was a majority. I think it was about 65% of the fund was repurchase agreements. I don't know if we want to go down that rabbit hole.
No.
That would be really annoying. But it's all of these. And again, it depends on the type of money market mutual fund. Is it treasury only? Is it just broad-based money market that can hold investment grade type securities? So it can vary.
Yep.
But generally speaking, they're going to be ultra short-term securities, debt securities that will pay interest.
Yeah. And why they're interesting, or at least somewhat interesting, as interesting as they can get right now, why they're interesting is, again, the Fed fastest rate hikes in history, right? And so we're getting paid a lot for them before. I mean, before you bought a money market mutual fund 2-3 years ago, you were getting basically nothing, right? Yeah. Now you can get 4 or 5+% in those things. And so it's just a different story as a result of that. And what I always tell people about, our expectation generally is that rates are probably flat to slightly down, right? Over longer periods of time, we're probably not going to go significantly higher from these levels. No. And so a lot of time, we'll see. We'll see. Yes. I always have to say that. But, from our side, in saying that, it's not like money market mutual funds lose a bunch of money when that happens, right? In fact, they hardly ever lose money at all. What happens, though, is your reset rate goes lower, right? Because, in 7 days or in a month when that stuff matures that they're holding, well, if they're paying, the new stuff they're buying is going to be at a lower rate. So you get a lower rate as a result of that going forward. So I always caution people in saying that, it's not necessarily a massive negative when rates go down, because it's not like you're losing money.
Right.
You're just going to be able to earn less going forward. And so that's why they're interesting right now from our perspective, in the effect that you can earn a relatively healthy amount of return from those vehicles, but understand that over longer periods of time, that's probably going to be lower. And it's probably not going to keep up with other assets, right? Because the whole thought on those things is relative safety, right?
Yeah. Well, and I think right now you're actually getting more than inflation.
Yep.
And for, I'd probably say 95% of the time, you probably earn less than inflation.
Yep.
Right. So right now is a little bit of a weird period, and I would expect that to normalize at some point. Mm-hmm. But yeah, for right now, you're getting essentially I don't want to say risk-free, but relatively riskless 5.5%.
Yeah. Yeah. So it's interesting right now. We'll see. Yeah. Like you said, we'll see what happens with rates in the future. But that is an asset that people, like you said, there's trillions in it right now. And sometimes people probably don't understand as much about what am I actually investing in when I do that thing. So, all right, let's switch again here gears. I want to nerd out a little bit. So let's nerd out, kind of keeping this theme about, who is dependent on rates a little bit more. Let's talk about banks.
Okay.
And really, I want to nerd out just a little bit on when we say banks, right? We say banks, people have, oh yeah, I got my checking account. I go, when's the last time you wrote a check?
Oh God. I honestly have no idea. I don't. I thinking about it.
Now, you just bought a house. Did you have to write a check? You didn't even have to write a check for. Look at that, people.
Everything was wired.
Oh, look at that.
So I don't think
every check I've written over the last 3 years has been house oriented. And I'm just like, come on, man. Can I stop doing this?
I honestly have no idea.
Okay. My last, so I'm going to make fun of a friend of mine. He's a CPA. Great guy. But he was my last regular check because he would do my taxes and he would still take checks and I would make fun of him every year. I was like,
didn't have
dude,
a credit card system.
He got one. He was a little late to the game in that, but and now there's Venmo, right? And that's, we kind of go that route, but it always made fun of because I showed it my check register one time and it was 9 checks and 8 of them were his because that was the only person I was ever paying a check to at that point anymore. So half the time I don't even know where my checkbook is. If I had to write one right now, I probably could, but I always have to rethink the process. It's okay, what do I put in this line? What do I put in this line? That kind of thing. So, but when people think banks, that's kind of the general thought in the head, right? That's where I put my checking and savings. Well, there's a big difference, right? It depends on the bank you're talking about. In a regional bank and a smaller, small town bank, community bank, and these kinds of versus what we would call a money center bank. Can you kind of walk through the difference in those?
Well, that's pretty broad.
Yeah, it is.
So I mean, when you think of big banks, you think of Wells Fargo, you probably think of JP Morgan, you think of, I don't know if I consider Goldman in that, but Morgan Stanley. Those are the banks, right? Those big banks, JP Morgan, Wells Fargo, Bank of America, Goldman, Morgan, all those. Their business model is very, very different than the U.S. banks, the Fifth Thirds, the more regional banks.
And certainly Joe Blow Bank down at the corner of the small town.
In the city that I live in, it's a kind of a farmer town. So they have a farmer bank or a farming bank, basically. And, they have one little branch and it's probably 800 square feet.
So you'll get to know that Keith and Tyler are both what I call hillbillies because they live in rural areas. I'm a city kid and these guys like to travel a little bit more than I do. But they get the farmer banks.
Yeah. So my community has that. And that's a very, very, very different business model than the big, massive banks that everybody knows very well.
Yep.
And so the way that, like a JP Morgan is going to split out their banks, they're not reliant on their banking customers taking out credit cards or loans, right? They have other businesses.
Yep.
Now it's a significant portion of their business and a very important part of their business, but they're not reliant upon it, right? So when mortgage rates went from 2.5% in 2021 all the way up to call it 7 right now, their business model isn't going to crash because of that, because nobody's taking out mortgages right now, right? Whereas your community bank or your regional bank is much more reliant on that type of business because that's how they generate their revenue, because they don't have the other business lines like mergers and acquisitions. They don't necessarily have the trading business. They don't necessarily have the wealth management business, right? So they don't have that diversified set of revenue that the bigger banks have. And so they're much more reliant on you taking out a new loan, whether it's a mortgage or just a home rental, loan, or just a loan for autos or whatever it might be. Yeah. But loans are the primary driver for these more regionals and local banks.
Yeah, and I think that's the big, why I think that's an important designation right now is all the commercial real estate stuff we talked about, right? And so commercial real estate, obviously, post-COVID, people aren't going back to work as much anymore in the office, right? As a result of that, banks that have done a lot of commercial lending are wearing a lot of commercial loans. Yep. And there's a lot of worry with regard to, can they pay those? And are they going to pay those? Or do they just say, the markdown's too severe and I'm defaulting, right? And there's a lot of worry about it right now. We haven't seen a lot of evidence of it yet.
Not yet.
We'll see what happens. But that's where you want to separate your banks as part of that, is understanding who is reliant upon a lot of loan growth, right? To kind of continue to process, because not only will that hurt what they currently have on their books, but if people aren't going to build 30-story skyscrapers because people aren't going back to work anymore, well, that's a future revenue stream that just went bye-bye, right? And so there's a portion of that, and then understanding that bank who's very heavily reliant on that versus somebody who has diversified lines of business like a JP Morgan, Bank of America, like you mentioned before, that have, I always call it loans versus fees, right? That loans, you get a spread, right? You generate a spread. You get a bunch of deposits, you loan it out, you get that spread. That's how you get revenue off of loans. Well, there's a lot of different ways when you're doing wealth management or other things that you can get fees from. Yeah. And so that's how they diversify their business models. And Bank of America, JP Morgan, I would put Wells Fargo probably in there too. They just have a lot of different lines of business that allow them to be a little bit more diversified. It's not like it's not going to hurt. Like you said before, if people stop loaning money, it's going to hurt. It'll hurt. But there's other lines of business, whereas, other banks, and especially, like those smaller banks that are purely reliant upon loan growth, who they've been lending to already and who they can lend to in the future is a big concern.
Well, and I just think of my local farmer, right? Like the rates on farm equipment. Right. Farm equipment's expensive.
Yeah.
I don't know if you ever looked at not just your John Deere, like true farm equipment, it's expensive. And the interest rates that they're now charging on those loans is insane.
Changes the game, doesn't it?
So if they can no longer go out and finance a new piece of equipment, right, that's really going to have an impact on those community banks. So
yeah. So we'll see. I mean, from our side here and investing, I think we're concentrated much more towards the money center banks. We like the diversified lines of business. We actually think the businesses are actually in probably okay shape. We're seeing some earnings that are coming out here recently that kind of relay the same story. We're a little bit more cautious on the regionals and the smaller banks that are much more reliant on loan growth, especially commercial loan growth.
Well, and some banks have more rate sensitivity too, depending on how much they've loaned out from their deposit base, right? So, if interest rates go up 1%, one bank might have more sensitivity to that than another. So you kind of have to pay attention to that as well.
Yeah, for sure. So that's our nerding out. Hey, that's what we're gonna do. We're gonna get geeky on some things every now and then, but now we're gonna transition here to a little bit more fun called let's do a little wait what here.
Oh boy.
I brought some statistics. I brought homework here.
Right, let's see it.
So taxes. So April 15th just passed, right?
Real fun.
Yeah, exactly. We are just smashing the interest level here right now. So let's get banks and taxes. But I got some interesting stuff. I just want your reaction to these. Okay, so let's start with this one. The IRS collects $5 trillion per year in individual income, corporate income, and payroll taxes each year. $5 trillion. Do you even know what $5 trillion means?
No.
I have no idea.
I have a hard time comprehending billion.
Yeah. Right. I mean, and we have billionaires, right?
Yeah.
Elon and Bezos, they jump by billions every month.
I've done the math on that for like Jeff Bezos. There was like this, someone posted this little graph of what it feels like for him to afford something.
Yeah.
And it's like a $200 million yacht feels like you buying like $100 dinner or something. Like, I was like, how is that possible? How does that?
Yeah.
You just can't fathom billions.
No.
It doesn't register.
Right.
So when you go to trillions.
Yeah. Then it's just completely gone. Right. Because like you said, it's like billions of dollars when it flexes. It's like, what's the difference between 7 and 12 billion? I mean, you have almost twice as much money, but it probably feels like literally no different to you because you can afford everything already anyway. So now you throw a T on instead of a B, and I have zero idea what's going on there. It just sounds like a very, very big number. And it sounds like the IRS has a lot of money on their hands. But the other one that I thought, okay, so I figured if we were going to do boring tax code, I wanted to kind of throw this one at you. So the number of words in the King James Bible. So basically a full religion around this tome, 783,000. The number
783,000 pages.
Words in
Words.
the King James Bible. The same number, the words in the U.S. tax code, 4.1 million. 5.3 times the size of the Bible. The U.S. tax code is.
No wonder why nobody can understand it.
That's exactly right. It's why did we, I get, complexity. Hey, we have different businesses. People are doing different things. Citizens should not have to pass an SAT examination in order to pay their government taxes. I never understood that. The fact that the government cannot run a free tax site, and I'm like, I'm paying you money. And I'm hoping maybe I get some of that back at the end of the year because I probably paid you too much and some people didn't pay enough, right? Wherever that math is, that's also just crazy to me. If you just think about general taxes, is I always have to settle up at the end of the year.
Right. The government knows what you owe.
Yeah.
And they're like, let's see if you can
figure that out. Yeah. You need to figure this out and then give us our money back. So it is just an extraordinarily strange, and we've just layered on and layered on and layered on complexity on it. And that's just from my wait what perspective is like, what are we doing here?
Yeah.
I just can't figure that out. Like, there's got to be a way to simplify this so that we don't have 4.1 million words for a text.
I feel like it should be like a one pager. I know everybody's situation is different, and I'm pretty simple.
Yeah.
Like I don't own any outside businesses, but I feel like it should just be a one pager. Like, did you make X amount this year?
Yeah.
Check yes. Are they filing jointly, separately? Single, check the box, and then maybe add on a few of the like one page of deductions that you can take. Call it a day.
Yeah, because let's even cut half of the words out. It's still 2.1 million words. It's just craziness to me. So that's I don't even have a good like case for it outside of that. It's just this is what wait what does to me. It's like I don't understand it.
I'd be curious to know how many pages they add.
That's a great question. I don't know. I'd have
what
to do
what lobbyist group is in there.
Yeah.
Sweet talking one of the Congress members into adding something into the code that satisfies them and allows them to take some tax deductions.
That'd be a good nerding out segment too. Is what's the growth rate of words in the U.S. tax code? I'm guessing it's superseded inflation.
Probably.
Good. Okay. We talked about this a little bit, but I want to segment down here. Here's old versus young. Let's do this. Let's do old versus young on making payments. We just talked about checks, which it seems like we're both below that threshold, right? Okay. So we're out on checks. But walk me through
Although I will say I was at the grocery store the other day. And a gal, I won't say her age, I don't know how old she was, but she was writing a check.
Yeah.
And I was sitting there behind her. I was like, this is the slowest process I have ever seen. So people still do break them out at the grocery store.
Oh yeah, that's where I've probably seen them the most, right? I never, honestly, I just don't go to stores that often anymore. I have developed the Amazon crack addiction, if you will, and the effect of those packages at my house every day. I've even now added Walmart and Target to that list now too. So now I basically have no reason to go outside. There you go. It's pretty awesome. But yeah, I think that's where I've seen it. And you're absolutely right. Like that used to be, so again, older versus younger, like that used to be a normal process, like walking through, going through the line, going through the scale and watching the person write the check in front of you. Now I look at it like, what are you doing? Can we go, please?
Cash is even faster than that.
Yes. And so that's actually a good, do you carry cash? I don't either. See, Gangle, who you'll see out here, that's sacrilege to him, right? Yeah. He's always carried cash. I don't ever carry cash anymore. If I get robbed, they're going to be sorely disappointed. Yeah. They're going to get my phone, but
I'll cancel my credit card by the time they can use
exactly them. Right. Yeah, it's just a race to who can get there first in that. Because I never carry cash anymore. So I guess I wanted to talk about I wanted to start with Venmo. right? Is for those that's peer-to-peer transactions, right? Just have you found that, as an older person, I get into it, I use it, right? And I love it for peer-to-peer, but I don't see the avenue outside of that, right? Is that I owe Jim money for, he bought me a beer the other day and I'm going to pay him back, right? Here you go, Jim. What do you see for usage outside of just that? Or how do they, because PayPal's been a terrible stock, right? We can agree on that.
Terrible.
So what is the use case for Venmo? Because I don't pay anything for that. And I'm pretty sure, if Jim makes a transaction to Jane, he doesn't pay for that. No. How do they get any money?
Well, I mean, you can pay part of your transaction that you're making to have it be deposited into your account within like same time.
Okay.
So there is a fee that they do charge.
Got it.
But usually if you deposit, I think they say 1 to 3 business days, but I think it's always in my account like the next day.
Okay.
So I don't really need to pay for it to get there right now. But what they'll do is a lot of times people keep cash on their balance for Venmo, and that's what they'll use to make money off. So they'll invest in short-term notes to make some yield and cash sorting.
So there's a bunch of floating cash, right?
Yeah.
Jim paid Jane, Jane paid Bill, and all of these people are just kind of carrying balances, right?
And that money will flex for them, but I imagine it's probably billions or millions of dollars that they keep in that balance, and I'm sure that flexes up and down. So they're not going to invest. If you keep $10 on there, they're not going to invest all 10.
Yeah.
Right. But they'll probably take 2, 3, maybe even 5 and put that into something that matures in 1 to 7 days.
Gotcha.
And clip some yield off that.
Yeah, because there's probably like you said, some money goes out, some money comes in. There's always contribution, distribution, whatever you want to call it. But there's probably a stagnant amount of money, because from Venmo's perspective, probably it's a big pot, right? Is that, Jim's money? Yes, we've delineated whose money it is, and they have access to it in 1 to 3 days, like you said. But there's a big pot for us that kind of just stays there. And so let's invest it and get some revenue off of that. Yeah. Okay. That makes sense to me. What do you see for you? Like, do you see businesses ever doing that? Like, what's your opinion on that? Yeah. Do you see it already?
Yeah. All the time. Well, I wouldn't say like major businesses.
Okay.
But smaller shops, like what I call mom and pop type shops.
This farmer again?
Yeah. But even like little restaurants by us.
Yep. Oh, really?
Yeah, they'll do it.
Interesting. Okay.
It's just like scan the QR code, filters into their account.
Got it.
Right. So it is becoming more popular.
Okay.
I don't know if it ever really go mainstream.
Yeah.
To use that.
You know what drives me? What I always call the low hanging fruit of that I don't understand why they don't do is like service businesses, right? Is that, guy who comes and mows my lawn because I'm lazy. Mm-hmm. So they'll come and mow my lawn and then they'll invoice and all that. It's like, dude, just let me Venmo you and we'll be done. Now I'm seeing more of that. It has happened more frequently, but I can't believe everybody just doesn't do it. It's like, why not get your money immediately in a seamless type of environment rather than going through, well, I'll bill you later and hopefully in 60 days you send me my money. It's like, what are we doing here? Let's just get this done. It's not like it's, especially for most of those instances where it's like really short burst type of stuff. That seems to make perfect sense.
Well, I think it probably, I don't know what price point it would matter, but I think a lot of people still use the like split up into payments depending on what it is.
Yeah.
Apple has it built into their credit card where you can just automatically split it up into 4 payments if it's over. I think you can even do it on like $50.
Gotcha.
So I don't know if that's part of the concern with them is people still like to finance.
Interesting.
Because you can do all that financing stuff at 0% still.
Right.
With like a firm and
sure.
And they're
as long as you pay in like 4 payments.
Exactly. Or you can pay a fee to extend it to 6 or 8 payments kind of thing. So I don't know if that's the issue with these guys is they don't want to deal with that headache.
Yeah. Well, in a lot of it, and this isn't trying to be disparaging, but if they spent all their life in landscaping, they don't really want to talk about billing, probably a whole heck of a lot, right? So they've got a process down, they're comfortable with it. Inertia is, in my opinion, the biggest force in the world, right? Is that, this is working fine for me. Why change and give myself a headache? And so I think there's just a lot of that too.
Well, we had gutters put on the house the other, what's that, like 3 months ago in the middle of winter.
Yeah.
Because I was happy. But
The guy hates you.
like he did the classic invoice with like the white paper, pink paper, and yellow paper.
Oh wow, okay.
Like it was true.
Wow, you get triplicate.
Yeah.
You got triplicate.
Yeah, and I just gave him cash. It's like,
let's call it
like that's a perfect business to say, just Venmo me.
Yeah.
Way simpler.
Yeah. It seems to make sense to even the old guy here. So from that perspective, I don't know why you would.
Yeah.
Well, good. Well, last segment that we're going to talk about today is one of my favorites because we get to go anywhere. We're calling the spaghetti wall. We're just going to throw something at the wall and see what sticks. So I got one for Tyler today. So Tyler, at the beginning of April, there's this crazy thing that happens that the sun starts shining. Not in Minnesota, that doesn't ever happen. But the sun starts they're shining. There's things happening. I can't talk. And then there's this sport where they go out and play outside, and it's cool. It's called baseball. I'm not sure if you're familiar, but so the season started in early April. My question to you is, did anyone under 40 even notice?
Probably not. I mean, maybe you get the baseball junkie, but there's so many games for baseball that I do not care about baseball until fall. Yeah. Because that's when it gets fun.
And so, okay. So you care about the playoffs.
And maybe if for the Twin Stadium is fantastic here. Yeah. So we go to like maybe 2 games a year and sit outside and try and get a nice weather game, and it's fantastic. Yeah. But outside of that, I don't watch baseball until fall because it does not matter.
See, that I think is my thesis too, and especially so my hot take here is that baseball has now become the most hyper local sport that we have, because I don't know anyone outside of those hardcore junkies, which are getting smaller and smaller and usually older and older by the day. I don't know anyone that follows like aggressively a team that's outside of the region.
Well, you can't. I mean, it's 100 and how many games?
162.
I mean, between April and September. Yeah. They do 3 or 4 back-to-back days. I can't dedicate that time. Yeah.
And I think that is generally the thesis on most baseball people at this point right now, is that it's become a niche sport. I mean, there's basketball and football have football for certain is, that's a weekly ritual, right? For almost everyone. And they know everyone from like most teams, right? I mean, they can tell you players from a lot of different players, a lot of different teams. Baseball, some people that are still watching it can tell you a lot about their own players that they're following, whether that's their team in their local region or their favorite team, right? You got one, but I think most people, and especially people under 40 now, like I used to have baseball cards. I used to know statistics of teams. I used to know like Milwaukee Brewers players statistics back in the day. I don't even know 4 Brewers that play at this point anymore.
I can tell you one. Like the only names that I know outside of the Twins, and I don't even know that many on the Twins, to be honest with you, is like Shohei Ohtani, Mike Trout. Yeah. Like the big names that you hear on SportsCenter is all I know. I can't tell you anybody else on the roster.
Yeah, baseball's got, but the interesting thing about baseball is that I don't think attendance has plummeted. And here's my hot take on that, is that attendance is exactly what you said, is that you're not going to watch a game. No. You're going to enjoy a hot dog in the summer sun, maybe take your kids, spend way too much money. It's like Disney in that way, right? It's like you don't care who the latest characters in Disney are, but you go there to have fun and have a good experience with your family, right?
Yeah. If the game's good, great. Yeah. I'm just there for the sun and to hang out.
Hot dog and a beer and family. Yeah. That's what that game is. And so I think that's why attendance is held up. But I bet if you polled everybody in that, like, who is your favorite player? You give me your top 5 outside of the team you're watching right now. Most of them wouldn't have a clue, and nor do they care. So it's we'll see what happens in the future for that sport. But I gotta imagine television revenues aren't phenomenal for that until probably, like you said, playoffs start. Maybe it kicks in then.
Well, and half the games are at noon on a weekday. Yeah. It's like, who's watching?
Well, I wonder if the work from home contingent has started kicking that in a little bit, though, too. Is that, hey, you're sitting at home, toss the game on, or hey, you know what? My laptop works. Yeah. They got Wi-Fi at the field, that kind of stuff. So we'll see. But baseball has got an interesting dichotomy to figure out, but I don't think it's going away. But I mean, the national conversation around baseball, in my opinion, is gone. Would you agree with that? Yeah.
Until September. And
then depending on who the teams are, it depends on the level of interest, right?
Yeah, especially if Yankees or Red Sox.
Exactly.
Red Sox.
Yeah.
Some Cubs.
Yeah.
Some big team is in there, then
Milwaukee, San Diego, probably not gathering a lot of the no offense to our Milwaukee and San Diego listeners, but probably not gathering the amount that Boston, New York would, right? Yeah, and the Dodgers. Well, we're running up on time. We're hitting there. So let's call this a day. Thank you very much. And we'll keep doing this and we'll see what happens. All right. Take care of yourselves. Bye.